Financial Planner. Follow us on YouTube.
Really excited today. I'm going to be speaking to a real estate expert, an investor, an author, founder of Norada Real Estate Investments. His name is Marco Santarelli. A national real estate investment firm offering turnkey investments is what he runs. He's focused on growth markets nationwide. Marco Santarelli is the host of the Passive Real Estate Investing Show, and he's going to be a wealth of knowledge today. Marco, thanks for coming on the show.
Thank you, Ken. Great introduction. I appreciate it.
Well, hey, the pleasure's mine that you're here and we get to pick your brain and discuss the markets. It's what I love. And you know what? Real estate is one of those things that I've always had a passion. I can remember in high school going around with my partner now, and looking at investment properties and, discussing deals. And I just couldn't wait to get out into the market to start buying investment properties. But I graduated high school in 2006, right in essentially into the '08 financial crisis. And you know what happened there.
Wow.
There wasn't a whole lot of real estate investing that I got into immediately. It wasn't until about 2011, 2012 I bought property. But yeah, let's get your story on, what got you involved with real estate and just kind of your general thoughts on the economy.
Sure. Well, what got me involved is just knowing from a young age that real estate is a true wealth creator. And there were people that I knew that you wouldn't think were millionaires, but they were walking around kind of like the millionaire next door. And what did they all have in common? They all owned income-producing real estate. So when I turned 18, I've said this story many, many times, but effectively I was able to qualify for financing at the age of 18. So I bought my first rental. At the time, it needed a repair, so I fixed it up. I put a sign out. There was no internet at the time, so it was putting a sign out in the front and advertising in the newspaper. But I took applications, leased it, managed it myself. Many years later, I regretfully sold the property. Now, the good news is that I had a great gain on the property. I had a big chunk of cash in my pocket. The bad news is that property that I bought for probably $40,000 at that time was worth, or is worth today, closer to $400,000. So, the lesson to be learned, and what I share with your audience is, if you're going to buy income-producing real estate, you want to keep it for the long term. You never really want to sell it. And if you ever need to sell it, the only reason to do that is to reposition the equity you have in that property into a better market for higher gains. And we could do that in the United States, fortunately, tax-free through what is called a 1031 exchange. So to answer your question, I got started at the age of 18, and that's when I got the bug. And if you were to fast forward in time, over the course of years, I accumulated, I would say, in a 2-year period, 84 units. And so I continue to buy today. And I love real estate. I think it is a true wealth creator for everybody, and it is a fantastic way to generate passive income. So there you go.
Well, that's really interesting. Marco, what is the, benefits then that you saw in real estate, especially right now with such a unstable, potentially volatile market in this everything bubble? We're hearing that word right now, and even real estate potentially overvalued in different places. I know we were talking about the '08 financial crisis. Would you be able to comment on what the benefits of owning real estate in 2008 would have been versus, let's say, the stock market?
Well, all asset classes move in cycles, and this can get into a really deep discussion, but for your listeners to understand, you have to understand that all asset classes move in cycles. Prices go up, prices go down, and there's various factors that affect that. It could be supply, demand, interest rates, you name it. If you were looking at real estate in 2008, 2009, most people would have looked at you and thought you were crazy because the market as a whole got hammered. Property values came down considerably, but that would have been an opportune time to buy. In fact, from 2008 right through to 2012, property values were at their lowest point. It technically bottomed out in 2012. And again, I'm being general here, not specific, because all markets are local. So that means every market sits on its own merits and is different from every other market. But if we're just talking in general terms, 2012 would have been the absolute bottom, and that would have been the best time from a price perspective to pick up properties and build a portfolio. However, I like to say that there's really no bad time to invest in real estate. All time, anytime and all the time is a good time to buy real estate, because there are always deals to be found. And as long as the market makes sense and the numbers make sense, then you can find good investments to invest in. So I don't like to focus on dates per se, like you had mentioned 2008. I just like to look at it as, where are the best deals to invest in real estate today? And that will change from market to market as market cycles change. What you asked me is actually a very big, broad question, because you're asking me to compare markets. You're asking me to compare, one market to another market in terms of time. The bottom line is this: you will always find deals out there. You will always find cash flow positive investments to make, and you will always benefit from the benefits of real estate, which include the income from the real estate, the depreciation you get over 27 and a half years, the amortization of the loan that your tenant is really giving you, because they're the ones paying off the mortgage for you, the appreciation that averages out anywhere from 5 to 7% per year over a long term. And last but not least, and this is one of the greatest things about real estate as an asset class, because I know you on your show talk about, stocks and other types of assets. Real estate offers the ability to leverage your investment capital as much as 5 to 1. I mean, you could put as little as 20% down and have 100% of the benefits of that piece of real estate, only putting 20% down and borrowing the other 80% from lenders that are willing to give you a loan on the property. So I'm not sure if I'm answering your question completely, but
no, absolutely. It's one of those things where even if you're buying at a really overpriced value, unless you can't afford to make the payment or you don't have someone to rent out your property, eventually, especially if you're renting it out, that other person pays it off for you. So it's not a situation where you're going to lose money forever and it'll be 100% loss. There are situations like that, but if you play your cards somewhat smart, you're pretty safe when it comes to purchasing real estate. And that's something I really like about it, the safety of it. Marco, talking about the markets here, give us some idea of what are some of the hottest real estate markets out there currently. I know I live in Austin, Texas right now. Things are booming out here. Do you have any thoughts on as to also where the value areas are that people should be looking?
Well, it's kind of a funny question, because a lot of people and across the board, from sophisticated investors to your average Joes, talk about the quote-unquote hottest market, or where is the quote-unquote best market to invest in. The reality is that there's really no definition of what a hot real estate market is. Most people talk about a hot market in terms of historic price appreciation. And I look at it in two different ways. I look at it as, what were the highest appreciating markets to date? And then I also look at it more favorably in terms of, what are the markets that make the most sense to invest in from a financial perspective? If you have a positive rate of return and positive cash flow, I would call those, of course, in the right markets, in the right neighborhoods, I would call those the hot markets. So let's break this down. If you want to look at some of the hottest, again, quote unquote, hottest real estate markets over the last 12 months, and I'm talking from an appreciation perspective, you could look at markets like Nashville, Tennessee, which has really taken the top of the list in the last 12 months. It's appreciated almost 13%, which is well above historic norms. So, for those people who were positioned in that market, they've made off with some really good gains. Seattle, Washington is on the heels of Nashville. Dallas, Texas, not too far from where you live, Ken. You have almost 11.2% appreciation over the last 12 months. Now, keep in mind, these markets I'm talking about metropolitan areas. They're very large metropolitan areas. So, you could break that down more granularly into suburbs and neighborhoods. But overall, you're looking at 11% in Dallas. Tampa's been on fire at 11%. Las Vegas has come around, close to 10% in the last 12 months. Orlando's up there at close to 10. This is a new entry into this list. Detroit, Michigan. Who would have thought, right? So Detroit has appreciated well over 9% over the last 12 months. Denver, Colorado should be no surprise to anybody. That market has been on fire for years. There's just been so much activity and movement into there. And I'm not sure if it's because of cannabis or not, but it's been on fire. A new entry to our list of markets, we're in 15, 16 different markets right now, is Milwaukee, Wisconsin. And we are going to be posting that in about a week's time. But that market has appreciated almost 9%. And by the way, as a side, we're also introducing Detroit as a new market for us. Now, we're not in the metro, we're not in the city of Detroit, we're in the suburbs, but it's the Detroit metro. Now, last on this list, Miami, Florida. That shouldn't be a surprise to anybody as well. That is an extremely cyclical market, and that's about 8%. But again, I want to emphasize one thing here. When you ask me the question about the hottest real estate markets, or when anybody asks me that question, I'll always push back a little bit, and I'll ask them, are you talking about appreciation, or are you talking about the hot markets in terms of being a real estate investor for cash flow? And if I was to answer it in the latter, what I would tell you is to look at markets, and these are examples, such as Memphis, Tennessee, Birmingham, Alabama, Indianapolis, Indiana, Kansas City, Missouri, San Antonio, Texas, Oklahoma City, Oklahoma, Atlanta, Georgia, Tampa, Florida. Those 8 markets I just listed are 8 of 15 that we operate in. The new one coming on board is Detroit, Michigan, and so that's how I look at things. I look at it from a cash flow and rate of return, not just appreciation perspective.
One of the things that I've pondered, and you can fill me in on this accordingly, it's kind of a follow-up to what you're just saying right now, and that is cash flow versus appreciation. Can you really get ahead with just cash flow in real estate? Because quite frankly, if you are just cash flowing, yeah, the numbers look great on the pro forma sheet, but if you have to redo your roof and your tenant destroys the place, you got just yearly expenses that just seem to come up. Cash flow seems to go away pretty quickly without that appreciation that gives you that real bump. Any thoughts on that?
Yeah, the short answer is you need both, and here's why. I think it's better to understand why. I like to say, first of all, you need the cash flow because you want income. You want to generate a positive return on your invested cash. We call that a cash-on-cash return. That's immediate. It's real dollars. It goes straight in your pocket. It's spendable cash. But I also like to say that the cash flow is the glue that holds your real estate deal together. In other words, it's what carries it from month to month and year to year as you build equity in that property. So that equity is what I would segue into calling the appreciation and the amortization. So you gain equity in 2 ways. Appreciation over time, because let's face it, you and I both like hard assets. Real estate is a hard asset. It's a fantastic inflation hedge. And so as time goes on, those sticks and bricks become more expensive. And that is natural appreciation. That's inflation. And we call it appreciation. So the value of real estate is supposed to go up year over year over the long term in an inflationary environment. But there's one other benefit to real estate. If you have financing on it, which I love, and your tenant is paying it off, as that mortgage gets reduced, you gain equity in that property. And so that amortization of the loan, it increases your equity just like the appreciation does. So you have this real estate portfolio and you get 2 benefits from it. You have passive income, which we all love, from the cash flow, and you have wealth creation through the increased equity in the property that happens in 2 ways over time. Could you get in terms of your ability to pay your bills, yes, but in terms of becoming quote unquote rich, no, it's not going to happen. You need both. And so when we work with clients, one of the first questions we ask them is, are you looking more for cash flow, or are you looking more for appreciation and equity gains? And some people are right in the middle. We take a hybrid approach to that, but different markets will give you more or less of each of those two factors. And depending on what you and your goals are, that's what you should be looking at in terms of a real estate investment. So that's the long answer to your short question, but at the end of the day, you do need both.
Marco, so because of the high costs of California, New York, Florida, we've seen, ideal and, very advanced cities, like Austin, Dallas, Denver, Nashville, they've boomed significantly. Now, we haven't seen that same sort of appreciation in, let's say, a city such as Memphis, Tennessee, to as large of a degree. And I'm wondering, what are your thoughts on Memphis? And I'm very interested in hearing what your thoughts are on Detroit. That was a shocker to me. Do you think that because these areas, such as Austin, Denver, Nashville, have gotten so expensive, some of these other cities are going to be the next ones to boom?
And so your question is about what? I'm sorry.
Yeah, so I was trying to frame that the best way possible. So we've seen Nashville, Austin, and Denver boom big time and go up. And because those cities have gotten very expensive, do you see a spillover of people going to areas such as Memphis and maybe even Detroit or some of the other cities to have like this aftershock boom that is going to spill over from these, very hot markets that might otherwise be unaffordable now?
Well, yeah, it depends. At the end of the day, people move because of jobs. So if you're in a market and it's a healthy market and it's an affordable market, so your cost of living is low and there's jobs and job growth, you're going to see people move there and population increase, and you're going to see demand for housing increase, both for sales and in terms of rentals. So really the primary driver comes down to the health of the job market. Now, the other factor that plays into that is supply and demand. Some of these markets you're mentioning are constricted in terms of supply, and partly because of their ability to build or the number of permits they can get to add new housing stock. And so when you have constraint on supply and you have real demand for housing, that's going to push prices up as well. And we see that happening in the south, not in the south, in the Bay Area of California. So what I foresee happening is some of these markets that are not overpriced today ultimately will become overvalued. CoreLogic, one of the largest researchers and data aggregators here in the U.S., they put out reports every year. Their recent report showed that nearly 50% of the nation's largest 50 markets are overvalued. Different people measure that in different ways. A lot of the time it comes down to affordability. But New York City, Denver, those are overvalued markets. Those markets have appreciated considerably here over the last 2 to 3 years. Nationwide, and again, just for your audience to understand, there is no such thing as a national housing market. It doesn't exist, and you can't point to it. There is no national housing market. But when you look across all 400 plus metropolitan areas, you can look at what housing is doing as a whole, and the national home prices have gone up 7% over the last 12 months, which is a little on the high side of the normal range. But what happens is in these overpriced markets, it's just adding fuel to the fire, and they become more and more overpriced. Example: San Jose, California; San Francisco, California; Vallejo, California; San Diego, California; Stockton, California; Santa Rosa, California; Sacramento, California; and Modesto. So if you look at the top 10 overvalued markets in the country, 8 of them are in California. It's no surprise that we're seeing this on the coastal markets, because the coastal markets of the U.S. are very cyclical in nature. My prediction is that we're going to continue to see prices appreciate just because we have a shortage of housing stock. We need about a million new housing units per year to keep up with population growth. And in the recent past, we've only been producing about 750,000 units to put into the market in terms of new households. That's just not enough. So at the end of the day, we have strong demand, we have a limit in supply, and that's going to continue to keep these markets appreciating and expensive, and we'll probably see more expensive markets.
Marco, let me get your thoughts then on Detroit. I'm curious as to, why you're looking in that area. Is it something you see in terms of job growth? Is it the Trump economy favoring maybe the Midwestern states that you see as bullish for the economies there? What are your thoughts?
The short answer is this, and just to be completely transparent, I have not been a big fan of the Rust Belt, including the Detroit metro area. I just don't favor the Rust Belt. Now, we do like the Chicago market, the greater Chicago market, but Detroit has kind of been the poster child of corrupt government, entitlement programs, a mismanaged, misrun, city. It's been a disaster. And so, people would say, well, why in the heck are you looking at Detroit? So just to be clear, it's not the city of Detroit as much as it is the MSA, the suburbs that surround the Detroit metro area. There's a lot of money coming back into that region. And so because of that, there's a lot of push for businesses to come back in and expand, which will drive jobs. The numbers work incredibly well in the suburbs, so there is a large rental pool. There is a great great as in size population. The numbers work. I will say this. I also know someone fairly well that lives and does a lot of acquisitions and rehabs in the metro area. And I've been watching him for the last year, and I'm actually surprised by the quality of the neighborhoods, the quality of the product, the stability of the tenants, the length of time the tenants stay there, and the price to rent ratios. So I'm just kind of thinking that maybe I'm getting in my own way and not recommending a market that actually can and will make sense for some investors.
Sure. And I'm almost reminded about never being so altruistic about some sort of investment and leave aside the possibility that there might be an opportunity somewhere.
Right.
And even, I know I would have invested a lot more money in Bitcoin, maybe invested a little more money in the stock market had I not been so altruistic in some of my precious metals holdings.
That's hindsight.
It's hindsight, right? And so here we are. And the only thing we can do is try to make the best decisions and move forward. Marco, so last question that I have on my mind is multifamily versus single-family residence. I know this is the ongoing question. A lot of people were wondering about that. I'm in a spot where I'm interested in investing larger amounts of money, and to me it seems like it's time to go multifamily and leverage a larger amount and see a higher amount of cash flow. But correct me if I'm wrong.
Let's clarify one thing. When you're talking about multifamily, are you talking about 2 to 4 unit properties, or are you talking about apartments that would be considered commercial and over 4 units?
Well, yeah, please address both of them if you would.
Okay, so when it comes to apartments, everybody has been chasing the apartment deal. I'm not saying that the deals aren't out there. They're just much, much harder to find. I know people who have literally thousands of units in the apartment space that are telling me that there was a time where they could look at and underwrite anywhere from 5 to 10 deals and find one. Today, they're having to look at 100 in order to find 3 prospective opportunities to submit offers on, and then hopefully get one of those. If you look at Robert Kiyosaki's advisor, Ken McElroy, he has put the brakes on acquiring anything right now. He's he's still underwriting deals, but he's not finding them according to what he told me. And so he's just basically put the brakes on the apartment space in terms of acquisitions. So if you can find an apartment complex, great. Just make sure you verify everything. However, I like the 2 to 4 unit space. So everything from 1 to 4 units is considered residential in the lending world. So you get the best and most favorable terms in terms of financing. I like them all. I like single family duplex, fourplex. If I can find a duplex or fourplex today, which is very difficult to find unless it's new construction, then hopefully it's a good deal and it's in a good neighborhood, because that's key. Not just the market, but the neighborhood has to make sense. We don't get a lot of duplexes and fourplexes anymore, and when we get them, they're sold literally the same day. So unfortunately, investors are kind of forced to build their portfolios mostly from single-family detached residential properties, which we happen to love. And it's about 95% of the product that we sell to our investor clients. So there's nothing wrong with it. I know people who have 10, 20, 30, 50 single-family homes in 4 or 5 different markets spread around the country, and they do very, very well. So that's kind of the shortest answer I can give you to that question. At the end of the day is you can create wealth and passive income regardless of whether they're single family fourplexes or 50-unit apartments.
Well, I love it. And I love that you're providing an opportunity for people to make money, thrive, and build their portfolios and do it in something that is very predictable, and I like that. It's like that Warren Buffett investing strategy. Boring, simple, easy, but makes sense. And you can go to bed at night and really get some rest, not having too much stress, knowing that your real estate is going to be there and going to be worth something, and you got those checks in the mail, and that's the most important thing. Marco, I appreciate your time coming on crushthestreet.com with me today. If you want to share some closing remarks here for the audience, and also let people know where they can go to find your work, we're going to have the links in the description as well, but please share some closing thoughts.
Yeah, my closing thought would be this. You provide a valuable service, and whether it's podcasts or YouTube channel like yours, Ken, books and whatnot, I always tell people knowledge is power, and you should always be educating yourself. The more you learn, the more you earn. And I really am a big believer in education. So continually educate yourself. If you look at successful people, you mentioned Warren Buffett, Bill Gates, all these wealthy people, Mark Zuckerberg, they read books every day, every week. They're ferocious consumers of content. So educate yourself and take action. Those are really 2 key things to getting results and my success is I'm constantly learning and I'm constantly putting that to action. So that's what I recommend. And on that note, a good segue is subscribe to your channel. We put out a fair amount of free content, including our podcast, which you mentioned at the beginning. It's called Passive Real Estate Investing, and the website is exactly the same, passiverealestateinvesting.com. So that's a great place to find us and find some of our content, and that links over to our real estate website as well. So that's kind of our home.
Appreciate your time, Marco. It was a real pleasure to pick your brain today. Thanks for coming on Crush.
Anytime, Ken. I appreciate it.